Hello, everyone. I'm Don Harkins. This is the Don Harkins Real Estate Show. This is a special episode. We're only addressing one topic. Typically, we'll go over mortgage rates and the broader housing market and home prices. But over the weekend, news came out about a 50-year mortgage being proposed, and a lot of people are interested. Is this going to massively lower payments? Is this going to spark a housing market run up again in home prices? How big of an impact is this going to be? So, we are going to answer all those questions and break down exactly what a 50-year mortgage could mean for America's housing market and specifically for Florida's housing market if you're located in Florida like I am. What we saw over the weekend was a slew of headlines like you see here from all kinds of different news sources. And it says, you can see Bill Pulte on X saying, thanks to President Trump, we are indeed working on the 50-year mortgage. He calls it a complete game changer. And we're going to see if that's correct. Some of the notes: President Trump on social media mentioned the idea. William Pulte, who's the director of the FHFA that heads up Fannie Mae and Freddie Mac and would ultimately be the one to decide if this is implemented, said they were working on it. It says the housing market has been in a slump and elevated mortgage rates and prices have priced out many Americans. That's true. Also, slow wage growth has priced out many Americans, and high property taxes have priced out many Americans, and high homeowners insurance have priced out many Americans. So I'm not sure it's elevated mortgage rates alone. In fact, I'm sure it's not just elevated mortgage rates that have priced out many Americans. But amid a slump in the housing market, President Donald Trump over the weekend floated the idea of a 50-year mortgage and appears to have support of the agency. So let's break it down. What does that mean? How big could the savings be for a 50-year mortgage? We're going to go over a couple things. So, for one, we're going to talk about how much lower your payment might actually be. We're going to talk about how much more interest it's going to cost if you take advantage of this. We're going to talk about who could and should consider a 50-year mortgage, how it will affect home prices, how it might affect inventory in the broader market, and we're going to give some advice for sellers, buyers, investors, or even real estate agents who are now going to be answering questions and dealing with this potential financing product. So, who might benefit from a 50-year mortgage? First-time buyers could benefit, homeowners experiencing a temporary hardship, investors, and even home sellers. They all could potentially benefit from a 50-year mortgage. First-time buyers, they could buy a home sooner, right? If you have to wait to purchase, that's more money you're spending in rent. And we know that home prices appreciate over time. So while you're spending rent and waiting, the home price is going up. It's equity you're not building. So generally speaking, there's an expensive cost of waiting for buyers. So if a buyer can purchase a home sooner at a lower price and pay less rent because of a 50-year mortgage, that may be a good thing. They may also be able to buy a better home. If you're a first-time buyer and you're going into a home that you know you're only going to be in for 2 years or 3 years, now you have to turn around and pay closing costs again and get another mortgage and closing costs on that, and who knows what rates are going to be. And so it's a lot more efficient financially if you can stay in your home longer. So if it allows a first-time buyer to purchase a home that they can stay in longer and they don't have to sell after 2 or 3 years into a bigger home, then this could also be advantageous. Homeowners experiencing a temporary hardship. So, a 50-year mortgage would provide flexibility to manage unexpected higher monthly expenses. So, say you have medical expenses that come up, or a relative in another state has a natural disaster, home is damaged, a temporary loss of work. You could have the benefit of fixed rate financing, which you don't get with like a HELOC, and you could throttle your payment higher or lower as you're dealing with these unexpected or temporary hardships. So, 1 month big bill comes in, you can pay a little bit less on your mortgage. Once you get that under control, you can start making higher mortgage payments. You get hit with another unexpected or temporary hardship, you can make that smaller minimum payment. So the 50-year mortgage could give homeowners the ability to manage their total monthly housing costs. Investors, potentially a DSCR loan, if they'll do a 50-year DSCR loan, this would mean that an investor would have to show that the property brings in less money in rent in order to obtain a debt service coverage ratio loan. That can make it easier for investors to purchase properties. And the nice thing about a 50-year mortgage for investors is that they could adjust their payments based on the net operating income of the property. So if the property's sitting vacant 1 month or there's an unexpected capital expense repair, the investor could lower the payment they make while they manage that expense. And then once the vacancy gets filled or the repair is made and the reserves are refunded, the investor could increase that payment again. And then sellers, theoretically, 50-year mortgage, lower payment. That means more buyers can afford to purchase your home, which means it's going to sell faster. And if it's selling faster and there's more buyers, it's going to sell for more money. And we know that buyers typically are purchasing a payment, not a price. So if the payment goes down, they can afford to pay a higher price with that same payment. So could benefit sellers as well. So, getting to the nuts and bolts of the 50-year mortgage, how much lower is the payment and how much more interest does it cost? Well, we have to compare apples to apples. So, a couple things we know about the market right now. First time buyers, this is from the Profile of Buyers and Sellers report, which just came out, 2025 data. The median percent financed for first time buyers was 90%, which is down just slightly from 91% last year. So if we're going to compare apples to apples, and we're going to look at this 50-year versus a 30-year, we know that it's going to appeal most to first-time buyers. Those are the buyers that struggle most with affordability. So we can assume the average buyer is going to be putting down 10% based on this data that just came out. Then we have to look at the home price. And we know for our market, the greater Central Florida region, it's about $451,000. Now, this is higher than the national average, but it's a good even number. So we're going to use 450,000 as our price, and we're going to use that 10% down as our down payment or 90% loan amount. And then we have to talk about what are interest rates. The average 30-year rate right now is 6.32%. The average 15-year rate is 5.82%. This is a good place to pause and ask the question, what kind of rate should we assume on a 50-year mortgage? Are we to assume that a 50-year mortgage would carry the same interest rates as a 30-year? Are we to assume that it would be lower, like a 15-year? We know that typically the longer the period of repayment, the more risk to a lending institution, therefore the higher the rate. And so what you see here between a 15-year and a 30-year, there's a 50 basis point difference between those rates. I think it's prudent to assume there's going to be also a difference between a 30 and a 50-year rate. So for our comparison purposes, we will add 50 basis points to the 30-year rate, just like from the 15 to the 30-year, there's a 50 basis point difference. So these are our test case numbers pulled from the real world. Down payment of 10%, purchase price of 450, interest rate of 6.82%. Let's look at the numbers. Well, you can see here, 50-year mortgage, $450,000, loan amount 405, interest rate 6.82. The payment is $3,349 a month. If we look at a 30-year mortgage, all the same terms, payment is $3,480 a month. So how much cheaper is a 50-year mortgage than a 30-year mortgage? About 3.76% cheaper if we assume that 50-year mortgages are going to carry a higher rate. And I'm going to make the case just in a minute that they certainly would. If we assume that the rates are equivalent, then it would be about 8.15% cheaper. So quite a bit cheaper if we assume that it's equivalent rates. But I don't think we can assume that. I think we have to assume it'd be about 3.76% cheaper to get a 50-year mortgage. That's on the monthly payment basis alone. Let's look at the total cost to own the property. Over 50 years on the 30-year mortgage, you would pay $544,367 to own that home. The same rate, the same sale price over 50 years, you would pay $1,098. I'm sorry, $1,098,712 to own the same property. So the total interest and mortgage insurance, there's a mortgage insurance assumption in here, to own that property is tremendous, tremendous, more than twice as expensive to buy the home for the same price. So why would you increase the total cost of ownership or the total investment required by 100% to save 3.76% monthly? It's not even close, even if you assume that the rates are equivalent, that there is no change in rates, it would still be 1,000,006 to own that same property. So it just doesn't really make sense. When you look at the total cost of ownership, how much money you would have to pay over 50 years to save 3%, I don't see why anyone would be doing this. When we talk about that rate piece, saving 8% versus 3.7%, here's what we know about lenders. We know that a 50-year loan lasts a long time. Over time, a lot can change. The markets, the economy, jobs, inflation. More years means more chances that something goes wrong. A 30-year loan ends faster, so there's less uncertainty, and lower risk means the lender can charge a lower rate. You pay down principal faster on a 30-year, so your balance drops quicker. When the balance drops, the lender's exposure, how much they could lose, shrinks faster. In a 50-year, the first several years are mostly interest, so the balance barely moves. There's less interest collected over time. It sounds backwards, but lenders know they make less profit on a 30-year, so to make them appealing, they would price them attractively to encourage people to choose them. If a 50-year rate was the same as a 30-year, almost nobody would choose the 30-year. They would just choose the 50-year but make 30-year payments. So the only way you're going to get people to take those loans that carry less risk is to incentivize them with rate. And then investors who buy mortgagers, all these mortgages are sold to Fannie Mae and Freddie Mac, who then bundle them. This is where Bill Pulte comes in. Bill Pulte would be the first purchaser of all these new 50-year mortgages. If banks go out and start originating 50-year mortgages and Bill Pulte says, we don't want to buy them, there's no market. The lenders lend out that money and now they have to wait for 50 years to do it again. So Bill Pulte has to be on board. Bill Pulte buys those 50-year mortgages. He bundles them into mortgage-backed securities, and then he has to go out and sell those mortgage-backed security bonds. And so investors have to want to purchase them. But investors who buy mortgage-backed securities, they like the shorter ones. They like to get their money back and reinvest. So that is all reasons why we can expect that a rate on a 50-year mortgage would be higher than a rate on a 30-year mortgage. So knowing that the total investment required is 100% higher, is double, more than double, and that you only would save roughly about 3.7% per month on your monthly payment, who should consider it? Only the most motivated buyers, only the most distressed buyers who are in a short time crunch and have a very specific or singular property that they want to acquire and cannot qualify for a 30-year, but can't risk waiting until they can qualify for a 30-year. So an example of this, we see something, families are in a home and they're in the family house and a couple's getting divorced, and now one of the spouses has to come off of the mortgage and the other spouse has to take on the full cost of ownership under one person's income and one person's credit. And oftentimes it's hard for one spouse to qualify for the full mortgage and full payment that two spouses had qualified for and were paying. So in the event you have divorcing spouses and one's trying to take over a payment, they want to stay in the family home. Maybe that's a good example. If you just can't qualify with a 30-year, maybe you take out a 50-year. Barely qualifying buyers who need to purchase but expect a very short time of ownership. Somebody who is working for the military, they have a 3-year contract, they're being relocated to work on a short project here in our market. There's a lot of people that come here to work for Lockheed Martin or Siemens or Boeing, and they're on temporary assignments. They know it's not going to be long lived, but it's going to be 2, 3, 4 years. Um, Owning is better than renting. You can capture some of that appreciation and not waste all your money. You can still get the mortgage interest deduction, but you're not going to own the home for 50 years. So the full brunt of paying all that interest over time is not going to impact you. This would be essentially like an interest only loan almost. And then buyers who have absolute certainty of being able to refinance or pay off the loan within a few years. So if you're expecting a large inheritance, you can pay the loan off. If you're cashing in a large investment that's maturing in the near future, if you're selling a business, if you're just using this mortgage to get into the home and get control of it and get settled, but you're not going to be saddled with it for 50 years paying on it, then that's theoretically someone else who may be a good fit for this 50-year mortgage. Other than that, investors, run for your lives. Sellers, this is not likely to move the market. You cannot expect to see tons of buyers jumping into a loan product to save 3%. If we qualify 3% more buyers to be able to purchase homes, this is going to impact a small number of sellers in a very narrow price range, right? We're going to be seeing this most heavily used in the $350,000 to $500,000 price range if it comes to light. The general advice is, though, you should be steering clear of this most likely. There's more information that's going to come, undoubtedly. They're going to firm up what the rates might look like. We don't even know who could qualify. Could somebody refinance into a 50-year? Could an investor get a 50-year? Is it only for first-time home buyers? There's still a lot of information to come out about this, but to answer the initial questions and the quick questions that have been coming in, is this going to affect the market? Is this going to save me a lot of money? Is this something that could, you should really be considering and looking at seriously? In almost all cases, no. Many cases, this is a horrible idea. A very small number of people, this might be a useful tool in your tool belt, but overall, the total cost of ownership is just too tremendous. I hope this is helpful. Again, my name is Don Harkins. This is the Don Harkins Real Estate Show. If you need help with any property management needs, if you're interested in getting a mortgage, and most importantly, if you're looking to buy or sell a home in Florida, we have a great team of realtors that can help you out in all different markets throughout the entire state. So I encourage you to please reach out. And also, if you found this helpful, please hit the like button. Please hit the follow button. We come out with new videos like this anytime we see a major shift in the housing, the mortgage, or the property management markets. Everybody, appreciate you watching. Have a great day.